Welcome to the deep dive. All right, this week we're skipping the usual headlines.
Yeah, straight into the engine room.
Exactly. We've got the AI-generated performance report for futures for the week ending October 24th, 2025. And we're just going to tear right into it. The mission, really, is to pull out that critical financial DNA, not just, where prices closed, but the real story behind it, the volume, the power, the mechanics.
Precisely. We're aiming for that pure quantitative stuff that, cuts through all the market chatter. We want to know, where was the pressure really applied?
Right.
So we're looking deep into the trend classifications. Is it high, mid, neutral? That tells us about momentum, stability.
In direction.
And direction, exactly. And crucially, we're assessing the daily true value, the DV. This gives us an unvarnished look at valuation. Is something trading rich or cheap compared to its, statistically fair price?
And then there's the energy, right? The volume ratios.
Yeah.
Comparing daily volume to the day before, weekly to the week before, really gauging participation. Was it a high conviction move or not so much?
Yeah. Did it happen on fumes or real fuel? And of course, you can't ignore the buyer-seller power split. It tells you who is initiating. Were buyers chasing up, hitting the offer that's buyer up, or were sellers dumping, hitting the bid seller done? And we layer all that with the technical context, the big ones. The 200-day and 200-hour moving averages, the MAs for that long-term structural health check.
Okay.
And the squeeze indicators, too, measuring that volatility compression, put it all together and get this panoramic view, right? From treasuries like ZN all the way to crude, CL, and even the VIX.
Yeah.
VIX.
So stepping back for a second, looking at that whole landscape.
Yeah.
Did anything immediately jump out, like an overarching theme the AI picked up for the week?
Oh, definitely. A profound split, a real dichotomy, and you see it in some pretty extreme numbers.
Sure.
We saw this flood of capital into what looked like safety assets, right? Really intense, high-trend conviction there. But at the same time, the stuff that actually runs the economy, energy, grains, saw massive aggressive selling pressure. Huge undervaluation.
Wow. So a market really torn.
Deeply split between, fear driving one side and maybe fundamental realities hitting the commodities hard on the other. We got to follow those quantitative breadcrumbs, see how it played out sector by sector.
Okay, let's start with that anchor then, fixed income, treasuries. We're talking the 10-year ZN, the 5-year ZF, and the 30-year, the ZB. And you said consistency.
Remarkable consistency. It wasn't just consensus, it was high conviction consensus. All three, ZN, ZF, ZB, got slapped with a high trend, H trend classification.
And H trend, just to remind everyone, means what exactly from the AI's perspective?
It's signaling strong, stable momentum, support and resistance levels held, the move was sustained, organized. Basically, the upward push was clear, not choppy.
Got it. And that push was clearly buyer-driven. We saw daily buyer up and weekly buyer up across all three.
Yeah.
So breaking down buyer up again, buyers were aggressive. They weren't waiting for prices to come to them. They were hitting the offer, pushing prices higher. And seeing that on both the daily and the weekly time frame, that suggests a really strong, persistent demand, right, for U.S. debt.
Unconflicted demand, yeah. And what's fascinating is how the moving averages, those big structural lines, mostly back this up.
Mostly.
Well, the 10-year ZN and the 5-year ZF were textbook, both clearly above 200 days MA and also above 200 hours MA. That's classic healthy uptrend stuff, especially being above the 200-day. Means they've broken free from any longer-term selling cycles.
Okay, so where's the mostly? Where did it get interesting?
The 30-year bond. ZB, that's the outlier.
Ah.
It had the same strong buyer-up power, same high trend classification, yet it was below 200 days MA and below 200 hours MA.
Huh. So buyers were pushing hard short term, enough to create a high trend, but the long bond is still stuck below its major long-term average. Why?
That's the critical divergence, especially if you're trading duration. It tells you that the price recovery, the structural healing we saw in the shorter and midterm bonds just hasn't fully reached the long end yet.
Right.
The near-term buying is intense. Yes, that's your H trend and buyer up signal. But ZB still has significant ground to make up just to get back to its average price over the last year or so. It's lagging.
Suggesting maybe investors are happier locking in yields in that 5 to 10-year range rather than betting big on, long-term rates stabilizing or falling dramatically.
Exactly. They're not quite ready to make that full long-duration commitment yet, despite the current buying pressure.
Okay, and what about valuation, the daily true value, the DV metric? Were they cheap, expensive?
They were all trading a bit rich, actually. A premium compared to their immediate fair value calculated by the AI. ZN was just 1% overvalue, ZF was 2% overvalue.
Okay, pretty small.
But ZB, the laggard, was the highest at 4% overvalue.
Interesting. So the one struggling the most structurally was trading at the biggest premium.
And that makes perfect sense, quantitatively speaking. When demand is that persistent, that aggressive buyer up across the board traders will pay a premium. The overvalue status just confirms the price got slightly ahead of its immediate calculated fair value.
Right.
And seeing the 30-year at a 4% premium while still being below its 200-day MA just underscores how intense that short-term buying momentum must have been. It was strong enough to create a premium, even while fighting those longer-term structural headwinds.
Okay, so if fixed income was all about high-trend buyer consensus, let's flip to equities. The big indices, ES, NQ, RTY, YM/S&P, NASDAQ, Russell, Dow Minis. What was the vibe there?
A completely different picture. Here, the dominant classification was mid-trend, M-trend, and the power dynamic was clearly showing short-term seller initiations.
Mid-trend, so momentum, but maybe choppy, conflicted.
Exactly. Like the march will hit a pause button waiting for a clearer signal, and the power dynamic confirms sellers were leaning on that pause button, at least towards the end of the week. All four indices, ES, NQ, RTY, YM, showed daily seller D.
Okay, daily seller gen. Sellers aggressively hitting the bid on the daily time frame. But I see here the weekly power was uniformly buyer Dan. Can you unpack that divergence for us? Daily sellers, weekly buyers. What does that tell you?
That's a really crucial distinction for understanding the week's flow. Daily seller Dan means sellers won the immediate tactical battle, likely pushing prices down into the week's close, maybe some risk off into the weekend.
Okay.
But weekly buyer Dan implies that looking at the whole 5-day picture, buyers were generally absorbing that selling pressure. They weren't aggressively initiating, that's why it's buyer Dan, not up, but they were stepping in on dips, preventing a deeper slide, perhaps.
So start selling spikes met by dip buying.
Pretty much. That kind of internal conflict, that push-pull, is exactly what generates the choppiness you'd expect in a mid-trend market.
But did these moves have real conviction behind them? What about volume?
That's where it gets interesting. The conviction seemed, well, weak. We saw a pretty widespread drop in weekly volume compared to the week before. Look at ES, only 71% of the prior week's volume.
Wow, down almost 30%.
Yeah. NQ was at 78%. YM was even lower at 70%. The Russell, RTY, was the exception, closer to parity at 98%, but still not exactly booming.
So participation dropped off significantly in the major indices.
Drops of 20-30% in the big dogs. That's the classic quantitative signature of consolidation. Prices might be moving around, but without broad market agreement, without high participation, the moves lack validation. It screams M-trend, the market's waiting for something, a catalyst to break the range. The volume just wasn't there.
Okay, that's the weekly picture. What about Friday's daily volume? Any clues there?
It was mixed, actually. The S&P ES at 91% and NASDAQ NQ at 88% showed slower activity than the previous day, maybe typical Friday afternoon stuff.
Right.
But the Dow, YM, actually spiked. It came in at 111% of its previous day's volume.
So a targeted burst in the blue chips while the broader market kind of coasted into the close.
Seems like it. Focused activity there. And despite that late week selling pressure we mentioned, there was still some underlying positive sentiment carrying over. The open gap analysis shows ES, NQ, and YM all logged a gap up status for the week.
Meaning they opened Monday higher than the previous Friday's close.
Correct. Suggests some positive momentum or overnight buying carried into the week's start, even if sellers chipped away at it later.
Now let's talk about the squeeze indicator. Measures volatility compression, right? Like a coiled spring-building energy.
Exactly. It flags when a market has gotten unusually tight, suggesting volatility is likely to expand soon. A breakout or a breakdown could be coming.
And this metric was blank for a lot of symbols, but not the equities. They all had numbers. ES and NQ were both 9, RTY was 11, and YM was 13. What do those numbers mean?
The higher the number, generally, the tighter the squeeze, the more compressed the volatility. The fact that the highest readings across the whole report, 11 for the Russell, 13 for the Dow, were right here in equities, is significant.
Especially paired with that low weekly volume.
Precisely. High squeeze reading plus low volume suggests traders are really holding their breath. They're coiled, waiting for a clear signal, maybe a break of a key moving average, before committing big to a direction. Big potential energy buildup there.
Okay, and structurally, how are they positioned relative to those key moving averages? Still looking okay?
Mostly sound, yeah. No immediate 5-alarm fires. ES, NQ, and YM were all comfortably above both the 200 days MA and the 200 hours MA, so they've held their structural ground long-term and short-term.
But again, an outlier.
Always an outlier. This time, it's the Russell, RTY. Again, it showed that partial divergence. Above 200 days MA, so its long-term uptrend is still technically intact, but below 200 hours MA.
Ah, so it slipped below its shorter-term trend line recently.
Exactly. And that slip below the 200-hour lines up perfectly with its struggle to maintain volume parity. Remember, it was 98% weekly volume, lowest relative performance. It suggests the Russell is, technically speaking, the weakest link among the major indices in the immediate term.
Okay, now, brace yourself, because we're moving into commodities and energy, and you mentioned some extreme numbers here. This is where things get maybe a little wild.
Yeah, this is where the quantitative analysis shifts from nuance to something closer to spectacle. We see the biggest outliers in valuation, volume, everything. It really paints a picture of market psychology. Let's start with precious metals: gold, GC, and silver, SI.
Okay, what did the daily true values say about them?
The deviations from DV here are, well, frankly, alarming. Remember, DV is the AI's math on where the price should be based on recent action. Gold futures, GC, came in as a staggering, almost unprecedented, 55% overvalue based on the daily time frame.
Wait, 55%.
55% overvalue. And silver SI wasn't far behind, 48% overvalue.
Okay, 55%.
Yeah.
That's not just paying a small premium. That sounds like panic buying, like you're paying way over the odds because you need it now.
That's exactly the implication. It's like paying, I don't know, $15 for a $10 loaf of bread because you think the store's about to run out forever. You only do that under extreme duress, right? When you think supply is vanishing or the whole system's under threat. It's profound evidence of an intense flight to safety or flight to hard assets trade.
This isn't just market noise. It's a signal flare.
Absolutely. When people ignore the quantitative fair value by that much, they're reacting to fear, geopolitical, systemic, whatever. The demand curve just went almost vertical, extreme momentum.
Did the volume back that up, especially for gold?
For gold, yes. GC saw really robust activity. Daily volume was 110% of the previous day, and weekly volume was 111% of the week before. High volume, confirming that explosive, overvalued price move.
So conviction behind the gold panic. What about silver?
Silver's story is a bit different, and it shows the frenzy wasn't uniform. Despite being 48% overvalue, silver's weekly volume was actually quite low, only 67% of the week before.
Huh. So a massive price spike, but on relatively low participation for the week.
Yeah. It suggests the silver spike might have been less sustained, maybe driven by fewer big players, or perhaps just dragged higher in gold's wake, potentially less fundamentally supported than the move in gold. A secondary beneficiary, perhaps.
And technically, where did this leave them relative to the moving averages? Still fighting trends.
Very much so. Gold reflects this volatility perfectly. It was below 200 days MA, so structurally, still in a long-term downtrend, but it managed to get above 200 HRMA. It won the immediate short-term battle.
So short-term panic momentum versus a longer-term headwind. Sounds volatile.
Highly volatile, especially near those structural boundaries. Silver was even more precarious. Below 200 days MA and tagged as cross 200 hours MA. It spent the week literally sitting right on its short-term benchmark, trying to decide whether to follow gold or fall back.
Wow. Okay, metals, extreme overvaluation, panic signals. Now, you said energy was the mirror image.
Hard pivot, yeah. Look at crude oil, Seal. Where gold was 55% over, crude was massively 16% undervalued based on the daily time frame.
16% undervalued. Yeah. For something like crude, that's also a huge deviation, just in the opposite direction.
Yeah.
Suggests heavy selling pressure.
Aggressive structural selling, exactly. But here's the kicker, the real paradox. Pair that 16% undervaluation with the weekly volume ratio. Crude oil's weekly volume was absolutely enormous, 153% of the week before.
Whoa, 153%. Volume up over 50% week on week.
Massive surge in activity. And this was, even though its daily volume on Friday was low, only 48%.
So the big action happened earlier in the week. What does that combination huge weekly volume surge, rock bottom valuation tell you?
That is the quantitative signature of aggressive liquidation, or maybe capitulation. Massive supply hit the market, driving prices down hard. But the sheer level of participation, 153% volume, means every downward tick was met with frantic trading. People were dumping, or maybe others were aggressively repositioning, trying to catch a falling knife.
Leading to a price floor 16% below fair value.
Right. That level of activity and undervaluation happened happening simultaneously is a massive red flag. It could signal an imminent sharp price reversal is coming. Or, conversely, it could be confirming a really dire fundamental outlook that forced the liquidation. Either way, it's unstable.
And natural gas, NG. Did it follow crude's lead?
Shared the undervaluation theme, yeah. NG registered as 6% undervalue, and similar volume pattern too. Low daily volume on Friday, 68%, but high weekly volume overall, 118% of the week before. Reinforces that narrative of deep volatility and heavy activity across the energy complex. High participation, low valuation.
Okay, quickly on agriculturals. Corn, soybeans, wheat. Any standouts?
A mixed bag here. Corn, ZC, was actually 6% overvalue and flagged for unusual activity. Its power dynamic was really conflicted. Daily buyer up, but weekly seller dean.
So late week buying fighting a broader downtrend.
Exactly. A clear divergence, suggesting buyers trying to challenge the sellers aggressively into the close.
Soybeans.
Soybeans, ZS was mildly 2% undervalue and looks structurally weak. Solidly below both the 200 days and 200 hours MAs, but its weekly volume was high at 112%, suggesting that downside move had decent participation behind it.
In wheat, CW.
Wheat was deeply undervalued, matching crude oil at 16% undervalue. And importantly, wheat showed strong selling consensus. It was daily seller dean, A&D, weekly seller dean.
So unlike corn's conflict, here, sellers were clearly in charge across both timeframes.
Yes. That dual consensus gives you clarity. Sellers initiating moves consistently confirms conviction in the downside story, whatever the fundamental reason might be. That points towards likely trend continuation, unlike the mixed signals in corn. So quite the dramatic picture in commodities and energy.
Absolutely. We need to take a quick pause here, but when we come back, currencies, the VIX, and we'll tie all these quantitative threads together. But first,
yeah, if you're finding this deep dive into the numbers valuable, if these quantitative insights are helping you understand the market structure,
make sure you hit that follow button, turn on notifications too, so you get our full market analysis update first thing every week. We really appreciate you digging into this with us.
All right, we're back. Let's shift focus now to the remaining sectors, starting with currency futures. Looking at the Euro FX 6E and the Japanese Yen 6J, what jumped out with the Euro?
Well, the daily volume was exceptionally high on Friday, 138% of the previous day. Huge focus there. And it closed 2% undervalue.
Okay, high volume, slight undervaluation. What about the power dynamic?
A very clear split. Daily buyer up, but weekly buyer down.
Another one of those divergences. So you have massive volume coming in on Friday, buyers aggressively taking control, buyer up.
Right.
Directly challenging the broader weekly trend where sellers had been dominant seller Dan. That suggests a really sharp, potentially significant late week reversal attempt by Euro bulls. They tried hard to override the negative sentiment from earlier in the week.
And its open gap status was in range, meaning it opened the week pretty stable compared to the prior close.
Correct. No major gap up or down at the start. The drama was really in that late week power struggle on high volume.
Okay, what about the Yen 6J? It was 4% undervalue. Any structural signals?
A very important one, yeah. Tied to global monetary policy, potentially. It registered across 200 days moving average.
Crossing the 200-day. That's always a key moment. Which way?
The tag implies it was flirting with it, likely trying to get back above after being below, and significantly it managed to stay above 200 hours moving average.
So short-term strength trying to overcome long-term resistance right at that critical 200-day line.
Exactly. That MA cross on the 200-day is huge. It means the yen spent the week essentially deciding its long-term fate. Staying above the 200-hour shows short-term technical support, but that 200-day is the line in the sand. When a major currency hugs that benchmark like that, the market is super sensitive to things like rate differentials, central bank talk.
Got it. A successful hold above could set a whole new structural path.
Definitely one to watch.
Yeah.
Now, we touched on copper, HG, earlier in the context of metals.
Right, with gold and silver.
Let's just confirm its metrics. It was mid-trend, had a small daily squeeze value of just 1, indicating not much compression there, but its power was consistently bullish. Daily buyer up and weekly buyer up.
Okay, consistent buyers. And we absolutely have to reiterate its valuation alongside that power.
Yes. Critically, copper, HG, was also 48% overvalue relative to its daily true value, just like silver.
That really reinforces the idea, doesn't it? That the flight wasn't just to monetary hedges like gold, but spilled over into key industrial metals, too. Suggest maybe broader economic fears, supply chain worries, not just financial system stress?
Could be. It broadens the fear trade narrative significantly.
Okay, what about RBOB gasoline, RB?
Similar theme to the other energy products. Unusual activity flagged and high weekly volume again, 122% the week before. Continued high churn in energy.
Power dynamic?
Mixed again. Seller D on the daily, but seller up on the weekly. Another case of late week tactical selling, pushing against a generally more positive weekly backdrop where buyers had been more aggressive overall. Seller up implies sellers had to come down to the bid, suggesting underlying buyer support.
Got it. Finally, the fear gauge itself.
Right.
The CBOE Volatility Index Futures, VX, where did it land?
Interestingly, the VIX was classified as end-trend neutral trend, so no strong directional momentum according to the AI, yet it was 4% overvalue.
Neutral trend, but still trading at a premium.
Yeah.
And daily volume was high.
Yep, 120% of the previous day. Significant activity on Friday. And the power was split again. Daily buyer Dean, but weekly buyer up.
Okay, let's piece that VIX puzzle together. Weekly buyer up suggests fear or hedging demand built during the week, right? Pushing the price up, hence the 4% overvalue.
Right.
But then high volume on Friday with daily buyer Dean, does that mean buyers became less aggressive? Maybe even sellers stepped in late Friday, suggesting a release of that fear premium into the weekend.
That's exactly the read. The weekly buyer up confirms hedging demand or speculation push VIX higher over the 5 days, but the high daily volume combined with daily buyer Dean implies buyers backed off or short-term sellers hit the VIX late in the week. A momentary sigh of relief, perhaps, or profit-taking on hedges, even as the overall weekly structure remained elevated. The market ended Friday maybe a bit calmer than the VIX price suggested earlier.
All right, let's pull that lens way back now. Connect all these quantitative dots across the different markets. The report for the week ending October 24th. You said it was a story of extremes.
Definitely. Let's anchor this synthesis with those massive true value deviations. The panic buying, the flight to safety, it's undeniable when you see gold at 55% overvalue, silver at 48%, and copper also hitting 48% overvalue.
Those aren't just numbers. They're quantitative flags screaming major risk aversion. Price sensitivity just went out the window. Peak fear priced in.
Absolutely. And the counterpoint is just as stark. The most undervalued assets, crude oil, negative 16%, wheat, negative 16%, followed by natural gas, negative 6%. These are fundamental industrial and food commodities.
Creating that powerful paradox you mentioned earlier.
Exactly. Assets linked to financial fear are wildly expensive, while assets linked to real-world production and consumption are deeply discounted. That signals a massive potential dislocation between financial market sentiment and maybe the underlying economic reality or near-term outlook.
Okay, valuation extremes paint one picture. What about participation? Where was the actual activity concentrated? The volume ratio analysis.
This tells us where traders were putting their money and attention. We saw those massive disruptive volume surges compared to the prior week. Crude oil leading the charge at 153%.
Incredible.
RBOB gasoline at 122%, natural gas at 118%. That energy complex was clearly where the structural volatility and the big fundamental bets were happening. Volume surges like that confirm a major shift is underway, cemented by high participation.
And where was it quiet? Where did participation drop off?
That was clearly the equity space. E-mini S&P 500 at 71% weekly volume, NASDAQ 100 at 78%, Russell 2000 lowest at 67%. While prices were moving around in that mid-trend chop, the lack of conviction relative to the week before is telling. It suggests the equity market kind of entered a holding pattern, overshadowed by the really decisive high-volume action elsewhere.
Right, consolidation confirmed by low volume.
Exactly. Finally, let's look at consensus versus divergence in the buyer-seller power. Where was there clarity and where was the conflict brewing?
Clarity seemed to be in treasuries, right?
Crystal clear. Strong buyer up across ZN, ZF, ZB demonstrates unambiguous institutional conviction in bonds as a safety play. We also had that clear seller DN consensus in wheat, ZW. Those are the charts offering the least internal contradiction, reinforcing their trends.
But the divergences. Those are the tactical hotspots for the week ahead, where things might flip.
They're definitely the areas signaling potential trend exhaustion or reversal. We saw that conflict in the Euro FX 6E, daily buyer up versus weekly seller do. We saw it in gold GC with its mixed MA signals despite buyer up power, and in corn ZC. These divergences highlight powerful late-week reversals, challenging the established weekly narrative.
So if that daily power signal, like the buyers in the euro, manages to hold early next week.
Then you'd expect a potential trend shift, yeah. The short-term momentum could override the previous 5-day story. Those conflicts are where the immediate battles will likely be fought.
Okay, so wrapping this all up, if we had to synthesize the key takeaway from this deep quantitative dive,
The overarching theme, I think, has to be that structural flight to safety clashing with aggressive liquidation in fundamental commodities. We saw the stability in fixed income contrasting sharply with the consolidation and late-week selling pressure in equities.
and the standout signal being those almost unbelievable overvalue numbers in precious metals.
Right. Gold at 55% overvalue. That confirms peak fear, a dramatic disconnect from normal valuation metrics. It paints a picture of a market signaling instability through really extreme price distortion.
Safety trade pushing gold sky high, while the real economy stuff like crude and wheat gets hammered 16% below value, all amidst huge trading volume. That core dichotomy seems to be the dominant message.
It is. And that brings us to the final thought, something for you, the listener, to mull over. We spent a lot of time on that crude oil paradox. 16% undervalue, yet a monster 153% weekly volume surge.
Yeah, deeply depressed prices, but frantic activity.
So the question is, what single underlying fundamental event or maybe confluence of factors, could it be massive inventory builds, surprise production news, huge strategic hedging flows? What could be powerful enough to force both that extreme trading volume and that aggressive price undervaluation simultaneously?
Because that contradiction can't really last indefinitely, can it?
It feels inherently unstable. Figuring out what drove that specific quantitative clash in crude, that seems like the essential question this AI report leaves us with heading into next week.
A fascinating puzzle. And if this kind of intensive quantitative look beneath the market surface helps you navigate these complex moves,
We hope you'll consider subscribing or following.
absolutely. This is the kind of analysis we aim to deliver every week. Hit that notification bell and you won't miss our next deep dive into the numbers that matter. Thanks for joining us.